Hi, welcome back to the series of videos on Ind AS, that is Ind AS with Accountsman. In the previous lecture, we had started with Ind AS 16, property, plant and equipment, and we had also discussed what exactly do we mean when we refer to the word property, plant and equipment, what is covered, what is not covered, and we also went on to discuss when to recognize. So what and when is done. So in the today's lecture, that is continuation of Ind AS 16, we will be discussing how to measure a particular PP. So let's go to that part wherein I'll tell you how to measure a property, plant and equipment. Yeah. So the question to the answer to the question how to measure depends upon when are you trying to measure. You get that? So how to measure also depends upon when are you measuring. So it depends upon when. Okay, I'll write it as it depends upon when. It depends on when are we measuring. You get that? So it depends upon when. If I underline this word when and talk about when, there are two circumstances at which we'll go on measuring the asset. I'm going to say PP in our circumstances. Yeah, that is the first one, initial recognition, and the second one is subsequent recognition. Initial recognition means at the time of purchase. This is what? At the time of acquisition or purchase. So at the time of acquisition, how am I going to measure this PP? Subsequent recognition means after I acquire that specific asset, at the end of each financial interval, at the end of each financial year, how do I measure it? Do you get that? So this is anytime after acquisition, that is usually at year end. How do you measure it? You get that? If I want to answer this particular question, at the time of initial recognition, there is only one model available, that is cost model. So we can only measure the asset under the cost model in the case of initial recognition, or I can draw the line in black. You get that? Whereas if I go for subsequent recognition, I have two models here. I have two models. I can either follow cost model, or I have been given an option under Ind AS 16 to follow revaluation model. You get that? So if it is initial recognition of the asset, I don't have an option, I have to go by cost model all by itself. If it is subsequent recognition of the asset, the organization is given an option either to follow cost model or revaluation model. So we have to discuss what exactly is cost model, what exactly is revaluation model, and whatever comes within that same. So our first point of discussion will be cost model. So let us start with a discussion on cost model. So right now I am trying to discuss how do we exactly measure it in terms of cost model. So the first and foremost thing that comes to our mind when we talk about cost model is the word cost. So the question is, what exactly do we mean by cost? What is cost formula? Yeah, how do we compute this cost? So let us now answer this question, what exactly do we mean by cost, or how exactly do we measure the word cost? Cost comprises of three items. Number one, purchase price. After we purchase that specific asset, that is one of the part of the cost, but that is not the sole item in the cost. We would have to include certain other items also in the cost. So the next item that we need to include is directly attributable expenses. Yeah, if there is any set of expenses that is to be incurred with respect to the asset to make it in a working condition, that expense should be included. So that is the second part. And it doesn't stop here. There is a third item that we will include. The third item that we will include in the definition of cost or in the formula of cost is decommissioning or restoration liability. Yeah, this is the third component that will be included in the term cost. So we have how many? We have three. First one, purchase price. Second one, directly attributable expenses. Number three, decommissioning or restoration liabilities. These three items cannot be just discussed in a small time frame. We'd have to spend a lot of time on each of the components to understand them in detail. So first things first, we'll start discussing purchase price in detail. Yeah, let us go. So our present point of discussion is purchase price. Yeah, so this is first one. This is the first part of our cost formula. So what and all will purchase price include? The first and foremost thing that purchase price will include is we need to check whether this purchase price is available. Yeah, what should we check? Is it available? Yeah, there are two possible scenarios to this one. You get that? First one is a green one. Yes, the purchase price is available. Then the next one, I'll write it in this color. No, the purchase price is not available. So if the purchase price is available, we'll consider the purchase price. If the purchase price is not available, then how to measure it, that we'll see at a little later. So first, right now we'll start discussion about if the purchase price is available, how do we consider? If the purchase price is available, it will definitely be part of our cost. So what will I do? Purchase price. This will be considered. Next important thing is with regard to discount. Now, what do we do with respect to discount? Discount cannot be discussed as a bigger word. It has to be broken down a little. Yeah, discount can be two types. One, trade discount, and the next one is cash discount. Yeah, so trade discount is a discount given at the time of trade, that is at the time of purchase. Cash discount is a discount given at the time of settlement. Now, we are acquiring a property, plant and equipment here. When I buy that property, plant and equipment, if at that very moment, if they give me the discount, what will I do? It has to be deducted. Deduct it from purchase price. You get that? If it is a trade discount, I'll deduct it from my purchase price straight away. Whereas, if it is a cash discount, it will not affect purchase price. It will not affect purchase price. To be taken to PL. It should be taken to P&L separately as an income. It should not be adjusted against the cost, or it should not be adjusted against the purchase price. So that's the first and foremost point with respect to our discount. Sorry, second point with respect to purchase price, that is discount. We'll go to the third one, that is with respect to tax. Tax is a bigger word, cannot be discussed as a big word whole. We need to break it down into two categories. Input tax credit is available. Input tax credit is not available. If input tax credit is available, that is like reimbursement. I am paying to government now and I'll collect it later. You get that? So if input tax credit is available, as it is like reimbursement, will not affect purchase price. If the purchase price includes, we should deduct that specific part from our, a purchase price. It will not affect purchase price, and purchase price not to include. Purchase price, okay fine, I'll write it here. Purchase price should not include such tax. Purchase price should not include such tax. I'll write that not here. If I write it at a different place, you might see it little differently. Yeah, it should not be part of our cost. However, if input tax credit is not available, then what will I do? As input tax credit is not available, ouch. Yeah, input tax credit not available. As the input tax credit is not available, it is not something like reimbursement. Such tax should be included in the purchase price. Yeah, to be included in purchase price. Meaning, if the purchase price what is given to us in the question already it includes the tax, then we will not add it again. We'll leave it like that. And if it input tax credit is available and the tax is already included, then we'll deduct it. So we need to see whether it is actually included or not, then see whether input tax credit is available or not, and then do such change. I cannot give you common thumb rule whether to add it or subtract it. We need to use our analytical skills here. Yeah. So this is with respect to tax. Let us discuss the next point with respect to our purchase price, that is regard to deferred payment charges. Now I have been given an option by my supplier to pay the money in installments, or to pay the money little late, or we'll say little late. So what is happening here is, I have bought a fixed asset today, or property, plant and equipment today, and my supplier usually gives a credit term of 3 months, usually asks the buyer to pay after 3 months, but he looks at me, I look little cute, little innocent, little poor to him, so he'll ask me to pay after 4 months. If I asks me to pay after 4 months, it should be without increasing the price. Assume that the cost of our property, plant and equipment is 10,000. Because he is giving me 1 month extended payment term, he is increasing the cost to 11,000. You get that? Now the actual cost of the asset is 10. He is giving me that extra term at a certain cost of extra money, that is 1,000. Such increased price what I am paying should not be part of my cost. So if there is any increase in the purchase price because of deferred payment charges, those extra money that is paid is in the nature of finance charges, and including that money into the cost or not is completely dependent upon our borrowing cost, which is Ind AS 23. You have to check there. You get that? So I'll write the same here. If there is increase in purchase price because of deferred payment, then what will we do? Such amount is finance charges. Should we include in purchase price? No, we'd have to check what? I'm not telling you whether it should be included or not. We cannot decide it here. That decision has to be taken under Ind AS 23 borrowing cost. Ind AS 23 borrowing cost allows us to include such price, include such interest amount or finance charges in the cost, and let it capitalize only when that asset is a qualifying asset. So we'll discuss it there in that particular standard. As of now, what I'm trying to tell you is, whenever it becomes finance charges, capitalization is to be determined by Ind AS 23. To be determined under Ind AS 23, that is borrowing cost. So we cannot tell it here. Yeah. Usually borrowing cost says that it can be capitalized if the asset is a qualifying asset. So what do you mean by qualifying asset? It takes substantial setup time. Yeah. So we'll discuss it there when we come to Ind AS 23. So as of now, these are the important pointers with respect to purchase price. And I have to tell you one more with regard to yes. We have not started discussion on no yet. So the entire discussion right now what we're doing is yes. And I have to tell you one more point on yes. So let me tell you one more point on yes. What if I'm paying one consideration to acquire multiple assets? Yeah. The next important point is multiple assets for one consideration. You have read this in slum sale concept and all, where multiple assets are sold together. Here we are buying, we are not selling. If multiple assets are bought together, then we have that option that we discussed yesterday. Do you want to write it component wise or group wise and other thing? So how do we record it? Here we need to remember that the assets are supposed to be recorded at fair value. But, okay, I'll write that point. Assets are to be recognized at fair value. But that fair value is the value that we are recognizing under Ind AS 113. We'll discuss it in a separate standard. I'll tell you bits and pieces of it in this standard also. So for now, remember fair value concept. So something similar to what we learn in our FM. So assets are to be recognized at fair value. But what I pay to the person from whom I'm buying is purchase consideration. So there can be three cases. Fair value is equal to the purchase consideration what I'm paying. This is what? Happy case. This is a happy case. Then what will I do? I'll record the asset at fair value or purchase consideration. There is no difference. But what will be the value of the each component? I'll identify each asset's fair value and I'll recognize at that particular thing. That's what I told. No, assets are to be recognized at its fair value. Now the interesting case comes when two possible scenarios. Yeah, I'll write it here. The first one is fair value is greater than purchase consideration, fair value is lesser than purchase consideration. Yeah, what to do if my fair value is greater than purchase consideration? Can you record the assets still at fair value? No. Then we cannot record the assets higher than purchase consideration. Like there is an asset which you paid 100 rupees and then got the asset, but you expect the value of the asset to be 110. Can you record the asset at 110? Meaning if you record the asset at 110, cash going out is 100, that cash is being replaced by an asset by name 110, so there is increase in the assets by 10 rupees. It is like profit, which is against the prudence concept or conservatism. We cannot record that amount. You get that? So whenever the fair value is greater than purchase consideration, then what will we do? Record assets at purchase consideration. But purchase consideration is lump sum. How do we apportion it among each assets? Yeah, based on fair value of each component. How do we determine the value of each asset? Now I bought 5 assets together. You get that? 5 assets together, when I buy it, I have the purchase consideration for all the 5 assets together. How do I identify the value of asset 1, asset 2, asset 3, asset 4, asset 5? I will determine the fair value of asset 1, asset 2, asset 3, asset 4, asset 5. In that proportion, I will identify the the purchase consideration. Now assume a case where my fair value is 110 and my purchase consideration is 100. Now this fair value I'll have asset wise. No, first asset maybe 20, second asset 50, 70 or third asset 40. So I have it in this way. So this is 1, 2, 3. So 2 is to 5 is to 4. I'll allocate this 100 in the ratio 2 is to 5 is to 4 and then write it for each of the assets. So that is what I am going to do in this particular case. Yeah, I hope you understood. Yeah, next case is a very important case. When the fair value is lesser than purchase consideration. Here, assume that the fair value of the asset is only 90, but I paid 100 rupees to get it. Then what will I do? Will I do the same thing again? Will I record assets at my purchase consideration? No, I'll record my assets at fair value, not at purchase consideration, because see, value is 90 of the assets, but I paid 100. So if I'm paying 100 rupees for a 90 rupees asset, it is loss. Here you cannot say that you will not record it. Why? Because it is substance, so it is a conservatism concept. You need to account for expected expense and losses. So you need to record the asset not more than fair value. You need to record the asset at fair value or purchase consideration, whichever is less. You get that? So the entire concept is the assets need to be recorded at fair value, but not more than purchase consideration. If your fair value is greater than purchase consideration, then we'll record at purchase consideration only. So technically the answer is asset should be recorded fair value or purchase consideration, whichever is less. This is an unspoken rule in the standard. If you want, you can make a note. So the multiple assets, when it is purchased, it should be recorded fair value or purchase consideration, whichever is less. So we'll go back to here. When the asset is recorded at fair value, individual assets ka fair value you have, at that value you will write it. But what will happen to the differential amount? Meaning, assume that the fair value is 90, but the purchase consideration is 100. So you gave 100 rupees cash, but you will recording the assets at 90. That 10 rupees is missing. That is capital loss, and that is something that we call as goodwill. You get that? Goodwill is to be recognized. Yeah. How much is the goodwill here? Goodwill here is purchase consideration minus our fair value. How to treat this goodwill? That we are going to learn in our Ind AS 38. When we discuss intangible assets, we'll discuss it. You get that? So treatment further discussed in Ind AS 38. Ind AS 38, when we discuss intangible assets, we'll learn how to handle this particular part of goodwill. So right now what we discuss, how to handle it when multiple assets are acquired for single consideration. So all we discussed till now is this yes. Now we would have to discuss no. So I'll write here. Here what we discussed is also still yes sir. So now I'm going to take you to discussion of no. What do you mean by no? When I say no, what I mean here is purchase price is not available. Now you tell me, when will purchase price be not available? There are multiple scenarios. The first possible scenario where the purchase price is not available is asset is developed in-house. So what will I rate it? It's a self-generated asset. Yeah, if the asset is built inside the organization, then there will be no purchase price. Then what will we do? Then the answer is pretty simple. Purchase price is 0. You didn't buy it. When you don't buy it, you don't have any purchase price. Sir, then will the asset be recorded 0 rupees? No. You need to remember that when I told you the concept of cost, it is 1 plus 2 plus 3. We're discussing 1 till now. So if there is any direct expense that is incurred for the purpose of that asset, that expense will become the cost of the asset. So we're discussing 1 now. Under 1, we have yes, no. We've done with discussion of yes, we're discussing no right now. Under no, I just told you one part, that is self-generated asset. Whenever there is self-generated asset, the purchase price will be 0. And whenever the purchase price is 0, then what will happen? With respect to this asset, the purchase price will be 0 and there will be no cost component relating to purchase price. There will be only component relating to expenses incurred. Then we'll see the next component. Yeah, that is when the asset is acquired for non-cash consideration. Like usually whenever we buy the asset, we give them cash. However, in this particular case, we are taking one asset from them and giving another asset to them. So this is something like, can I call it like barter? You get that? Whenever there is a barter transaction, how to recognize the cost of that specific asset? So we need to ask certain questions to ourselves here. So the first and foremost question that we need to ask ourselves here is whether there is commercial substance. Is there a commercial substance? So we need to question this to ourselves. So there are two possible answers here when we ask this question. The first one is yes, and the answer number 2 is no. Whenever there is commercial substance, it will become a transaction. Whenever there is no commercial substance, then what will happen? Not okay, PPE. It will not affect our PPE only. It's like this. I have biscuits and my friend has chocolates. I'll give biscuits to him and I'll borrow chocolates from him. So this is not a commercial substance. There is no commercial substance in this. So it is not PPE and will not be discussing under Ind AS 16 at all. Whenever there is commercial substance, then we need to see. Then I'm going to tell you how to record this particular thing. So this is me. Yeah, dabbing. And there is another friend of mine. And this friend of mine is lazy. Yeah, this friend of mine. Or what do you say, my other party. So what I am doing is I am giving this person one asset, and what am I getting in return? Another asset. So for our ease, I'll call this asset 1 and I'll call this asset 2. So what am I giving? Asset 1. What am I getting? Asset 2. So how do I record? So basically this asset 1 is disposed. Yeah, that will transfer that, so the carrying value will be removed from that particular part. That is not a matter of discussion under PPE. Right now, our area of importance is this asset 2, what I am acquiring. How do I record it? There is priorities here. Yeah, priority number 1. Yeah, first and foremost thing that we need to see is this will be recorded at fair value of asset acquired. So I'll first record at the asset acquired's fair value. This asset, whatever I acquired, at its fair value, I'm going to record. What if that asset acquired's fair value is not available? Then at fair value of asset given, I'll follow the fair value of the asset given. If that is also not available, then what will I do? Then third possibility, at carrying amount of which one? Of asset given. So there is 3 priorities. Number 1, the asset what I acquired, I'll try to recognize the fair value of that asset. I'll record the asset at that value. If that is not available, then I'll try to identify the fair value of the asset that I gave. If that is also not available, then I will go to the carrying amount of the asset that I gave, and the asset that I got will replace the asset that I gave. And who told this entire thing? Don't tell. Yeah, sir told me this. This entire thing is given by our Ind AS 113. which talks about fair value. Whatever is told there, I'm trying to give a gist of it here. I could have told you a little differently. Fair value available, fair value not available. Fair value available, recorded fair value. Fair value not available, recorded the carrying amount of the asset given. That fair value available, if it is available for the asset bought or asset received, recorded. No, the second priority will be fair value of the asset given away. This is basically given over Ind AS 113, but it is to be known in our Ind AS 16 also. So before starting Ind AS 113 only, we're discussing some part of our Ind AS 113 here. So this is how we record for a transaction which is of which doesn't have consideration. Non-cash consideration may purchase price is identified like this. And I have to tell you one last point with respect to purchase price. You get that? Last point on purchase price. Okay, treatment of government grant. Yeah, this is usually regulated by Ind AS 20. So I'm trying to cover a little part of it here. So usually covered by Ind AS 20. If you can remember our accounting standards, accounting standard 12 which dealt with government grants gave us an option either to recognize that government grant by decreasing the cost of the asset or defer and amortize it over the useful life of the asset. Whereas under Ind AS there is no such two options given. There is only one available option. So what should we be doing? This cannot reduce the cost of the asset. Yeah, I'll write here asset to be recognized at fair value. You cannot reduce the government grant from the asset value. What will we do with government grant? Government grant to be deferred reserve, or it should be transferred to revenue over the useful life of the asset. So how do we transfer it? Transfer to PL over the useful life. You get that? How do we when do we transfer this? What to say? Subject to fulfillment of conditions. Subject to fulfillment of conditions. You get that? We usually will be given with lot of conditions. No, government will not give the grant straight away. They'll tell you that I'll give the grant if you can increase your production capacity to this much, if you can employ those many people, if you can export so much. So only based on those conditions. Whenever there's probability of fulfilling those conditions, then such amount which is treated like reserve as a deferred revenue or deferred reserve on our equity, that will be transferred to our statement of profit or loss over the remaining useful life. It might be a case where grant is received in year 2020, but we have a possibility of fulfilling the conditions, or we'll feel that we'll fulfill the conditions only by 2022. So you cannot transfer that grant to P&L in the first 2 years. Ever since from the time wherein you start feeling like you will fulfill the conditions, you will start transferring. So I told you I use the word. So it's very important to refer to the word here, over the remaining useful life of the asset. So this is the entire discussion with regard to our purchase price. So we are done with the first part now. So now I need to start with the point 2, that is directly attributable expenses. So with regard to purchase price, we discussed this entire thing. Yes and no is also done now. Yeah, so no is in next slide. This is completely yes, and this is also completely yes, and this is no. Yeah, so now this is also no. This also with regard to no. So now I'll start discussing with regard to this second part in my cost formula, that is my directly attributable expenses. This video will be little longer than the usual ones because I want to finish this cost model or cost formula at least before I take it to the next session. Yeah, so come on. So let us try and discuss directly attributable expenses. Yeah, point number 2. Directly attributable expenses. So what exactly do I mean when I to the word directly attributable expenses? It includes all expenses incurred to bring asset to the required, important word now, location. Second important word now, condition. okay, intended for use. Yeah, okay, this management will decide what exactly is the location where the asset should be, what exactly is the condition in which the asset should be when it is intended for the use. So all those expenses will be included in my directly attributable expenses. So we'll have a lot of questions here is what are the items included, and we'll have a lot of questions regarding what are the items excluded, or what are covered under directly attributable expenses and what are not covered under directly attributable expenses. Now let me take this responsibility of mentioning to you as to what are the items included. Now assume that I bought a specific asset. It will not be bought right outside my factory. It will be bought at the place where that asset will be sold. So after I buy that asset, I'll say that asset come. Will it come? It will not come. I need to transport it myself. You get that? Before I transport it, everyone will see it. Yeah, nazar lagega, like drushti agate. So what should I do? I should basically load it, or I should pack it. So the first and foremost thing that will be included is packing. Then after that I need to load it. After I pack it and then load it, I'll say the truck to come. Will it come? No. I need to appoint a driver, I need to hire the truck, I need to pay for the transportation charges, only then it will come. So transportation. Yeah, whenever the truck arrives at my factory, I'll tell my asset, get down and then get into the asset. Keep your right leg first. Will the asset do that? No. I would have to take it down from the truck myself, or with the help of certain people. So unloading charges. Yeah, after I unload it, it's all packed. I need to unpack it. See, this is not the gift that you'll get on your birthday that you'll tear para. It might be very toughly packed so that the asset will not get damaged. So unpacking also might incur some cost. So after unpacking, it is not like you buy one machinery and that machinery is sent to you in one piece. It might be sold to you in a separate pieces. You need to read the manual and then you need to fix it. And this is not a toy car that you'll fix it by yourself. You might need engineering help. You might need architect or professional help to fix that specific asset. So assembly is also part of the assets cost. It's also included. And in the process of assembling, you might need some professional help. Yeah, like you might hire one engineer to fix that specific asset. So whatever the money that you pay to that engineer is part of the asset. Asset has to bear it, because the benefit of that engineering cost what you're paying is for the entire life of the asset. You get that? So that professional fee. After that, asset is completely done. Can you just start the asset like that? If you start the asset, it will start moving, because you need to fix that. So you need to incur some installation. You need to install that asset. No, you need to make that surface clean wherein it can be completely set. So what is a site preparation expenses? You get that? In order to prepare that site and that roof and everything, you might incur some architecture services also. That architecture's expense also will come as a part of our professional fee. All that is included. And once you do all this, what will you do when the asset is assembled, perfectly kept? Then you will do trial run. You get that? That trial run expenses is also included. So everything that you do till trial run is included in the cost of the asset. Yeah, we need to have a specific discussion with regard to trial run. So I'll discuss the trial run part and then let me just tell you what are the things which are not included. After the trial run, you might start functioning it. Initially, number of products produced from that asset might not be huge. You get that? So you might face some losses. So that is initial operating losses. That initial operating losses what you incur is not part of the cost. Or any operating expenses, normal course of operation, normal course of operation, you incurring that expense, you incur that expense now also. It is not something incurred especially for the asset, isn't it? So it is not part of the cost of the asset. Then normal administrative expenses. And whenever you use this asset, you might you are starting a new channel of production, new product line. So you might do lot of selling expense, you might do lot of advertisement expense. Yeah, you might do lot of distribution or marketing, or that new channel of production or new product you might advertise. All this is not included. And very importantly, inauguration expenses. Yeah, if you incur any expenses for inauguration, that ribbon cutting, and then use the put some sweets and then decorate it, yeah, and everything you put kunkuma and all that. So all those expenses are not included in the cost of the asset. You get that? So these are the items included, these are the items excluded. I told you with regard to trial run, we'd have to discuss a little in detail. So once we discuss that, we'll be done with directly attributable expenses. So now let me take this opportunity to discuss with regard to trial run. Yeah, so it's a very tricky part. Lot of us get tested on this part, and there are few questions in our ICA material also which lot of us get confused. The answer is pretty simple. What part of trial run is included? So with regard to trial run, there are two types of trial run. One is alpha test, second one is beta test. Alpha test is the test done by the developers. So what is this? Testing by developers. This is testing by user. Yeah, first I'll test it within the organization by myself, second I'll test it on the users. If it is alpha test done, then what is it? It is included in directly attributable expenses. If it is a beta test done, it is not included in directly attributable expenses. Why? If I'm testing it on public, the asset is ready for its intended use, so I'll stop. It is no more the first trial run and it will not be included in our cost. So this is one of the important point that I want you to know regarding our trial run. Done. So the next important point is with regard to trial run, we need to check as to what is the asset on which we're doing the trial run. Yeah, important part, concentrate, I'll explain it to you. Yeah, so what is the type of the asset? The first part is this an asset acquired or is this a self generated asset? Does it matter? Yes, it does. If it is an asset acquired, then what will happen? This trial run, assuming it to be alpha run, it is part of directly attributable cost. You get that? If it is beta, then it's not. You get that? So if it is alpha test on acquisition of an asset, then the trial run is conducted, then it is part of our what is it, directly attributable cost or directly attributable expenses. I can call it DAE if you want, DAE. Yeah. With respect to self-generated asset, yeah, what we need to do, I cannot tell it right now. It depends upon outcome. What does it depend upon? Depend on outcome. We need to see what exactly is the result. Yeah. So the result can be success or the result can be failure. If the result is a success, then what will happen? We'll stop the development of that asset. There is no more research and development. The asset is ready for use. So what will we do? Then it is part of our directly attributable expenses. However, if the asset is a failure, then what will happen? That asset has to re-go through the entire process of research and development again. So if it is failure, we need to go for one more test run. So this test run what we just did is revenue in nature. It is repetitive in nature. It is not one time. So this test whatever is conducted, it is not part of our directly attributable expenses. So that test expenses, yeah, test run expense to be charged to revenue. You get that? Why? Because the test run is a failure, it is not doing any value addition. If the test run is a success, it is making that asset functional now. We can use that asset for production. So then it will be included. So very important point with respect to trial run. Okay, with respect to directly attributable expense, any expense incurred till the time the asset is ready for its purpose, ready for its intended use, is included in the directly attributable expenses. If not, no. Or to be very clearly told, till the trial run, part of DAE, after trial run, not part of DAE. Trial run, very important discussion. If it is on the acquired asset, DAE included. If it is self-generated asset, it is part of DAE only if the test is successful. If the test is a failure, it is not part of our DAE. And the test expenses which are included in our which is included in our directly attributable expenses or cost is only alpha test expenses and not beta test expenses. These terms are not used in the standard with regard to alpha and beta, but this is something that I have concluded based on the understanding of the problems that I have usually solved in the class where IndAS was taught. Yeah, so that's with respect to our second part of the cost formula, that is with regard to directly attributable expenses. So now let me take you to the third part, that is decommissioning or restoration liability. Yes, so the third part. Decommissioning or restoration liability. Yeah, this is the expense to be incurred for the removal of the asset at the end of its useful life. Now I have installed one asset. Yeah, I have used it for the entire useful life. Assume 10 years. At the end of 10th year, when the asset is no more in active use, I have to remove that asset so that one more asset can be put in cross. And by lot of norms regarding our treatment of garbage, what is regulating, I can't throw that asset as junk. No, sometimes the asset might not realize scrap value, but asset might lead to negative scrap value, meaning I would have to pay money to remove that asset. Like when you throw your garbage out on the road, you cannot just throw it like that. You need to pay to the people who do that cleaning job. You get that? So you need to pay for wastage. So you might have to dismantle the asset, you might have to disassemble the asset, you might have to restore the entire site, so make it good enough to like install the next asset. Such cost will be called as decommissioning or restoration liability. Under accounting standard 10 there was no such concept, the old accounting standard 10. In the revised standard it's there. So what we used to do, at the time of removal, whatever expense incurred, it used to go to PL. Now at the time of removal, if there is any expense incurred, that expense is incurred because we used the asset for so long. You get that? So Ind AS 16 pushes us to record this expense as a proactive measure at the time of recognition of the asset only. So decommissioning or restoration liability is future cash flow going out. So because of, what do you say, our concept of conservatism, yeah, or prudence, we need to create provision for decommissioning or restoration liability. You get that? However, provisions are allowed to be recognized under Ind AS 37 on fulfillment of two conditions. So I'll tell you, we'll discuss it in detail when to recognize provision in Ind AS 37, but I'll just give you a little just here. So first one, there should be probable outflow. And the second important condition is there should be a reliable measurement. If both of these conditions are satisfied, then we recognize that provision. So I'll tell you, probable outflow. Definitely asset has to be removed at the end of useful life. Definitely you need to incur expense. So that becomes probable outflow. Second one is reliable measurement. So should be able to reliably measure as to how much exactly is the amount that you need to pay. You get that? Once we arrive at these two, then we need to record this. How do we record this? With regard to this entire thing, what do you say? Sorry, I'll tell you, with regard to provision especially, yeah, to be recognized at fair value. To be recognized at fair value. Whenever I tell fair value, again you need to remember, we need to go back to Ind AS 113. I'll teach you there. You get that? So with regard to that, we'll definitely identify the fair value of that specific provision, and then it will be recorded, and it will increase the cost of the asset. Now assume the asset is purchased for 100, and at the time of the end of useful life, I might have to pay 10 rupees for the removal of the asset. So then my usual journal entry will become like this. I'll write to bank. How much am I paying? 100. And I'll write my asset 100. But I need to incur 10 rupees for removal of the asset later. I need to find the present value of the 10 rupees. So 10 rupees is to be incurred after some 3 years. So the present value of it at some discounted rate is 4 rupees. Let us assume the present value is 4. So that 4 rupees will become my provision, 4 rupees. And my value of the asset will not become 100 in that case. It will become 104. You get that? Asset will be recorded at 104, bank, and then 4. And over a period of time, by the time 3 years, this provision will move closer towards our accounting estimate amount of 10, and that amount will be incurred. So this is how we do the accounting for this particular part. This provision, whatever recording, is an accounting estimate. You get that? We had discussed it in our Ind AS 8. Yeah, I hope you remember from there. So whenever this is made as an accounting estimate, we need to remember that it's an estimate. It can change at any point of time. So this provision is to be reassessed at regular intervals. Now what exactly do we mean by regular intervals? Depends upon the volatility of the component, and based on the professional judgment we can decide how often to reassess that particular part. And if there is a change, then what do we do? Yeah, if there is a change such change in provision need to be accounted. We need to, if the provision has increased, or I mean say my expectation about decommissioning restoration liabilities has increased, so my provision will increase, so that will lead to increase in the cost of the asset. If my expected expenditure on decommissioning or restoration decreases, then my provision decreases, my cost of the asset decreases. Such a change is to be affected on the asset. But how do we do it? It should be affected, such change in the provision is change in accounting estimate. It is not change in accounting policy. Such change is accounting estimate. And whenever there is change in accounting estimate, what do? We give prospective effect. Yeah, so whatever has happened has happened. I will not go down to change whatever already done. I will only change it for the coming years. So this year if there is a change expected, or this year if my provision is reassessed, I will adjust the cost for this year, and from this year on this revised cost I will start charging my depreciation. So that is with respect to decommissioning or restoration liability. So with regard to provision, we'll discuss detail when we start our separate standard that we have. So we're done with the decommissioning part, that is part 3 also. So if we can understand what we did in this particular video, that is part 2, is we started discussing how to measure PPE, and in the discussion on how to measure PPE, we discussed it depends upon when, that is initial recognition or subsequent. If it is initial, only cost model. If it is subsequent, we have option of cost or revaluation. When we discussed about cost formula includes 3 parts: purchase price, directly attributable expenses, and decommissioning liability. And all we did in this video is discuss each of the item, that is 1, and we have here 2, and the last one, that is 3, in detail. Yeah, in the next session what we will do is we'll discuss with regard to our revaluation. Yeah, how to account it in the revaluation case, and when we say cost model, how do we record it, when the case of revaluation, how to record it, and what exactly do we mean by depreciation, what is it that's been spoken about impairment, and quite a lot of other topics in our PPE. That will be the closure video. I know this video became little longer, but can't really help it. I didn't want to do it as 4 parts, so I covered entire PPE in 3 parts. So see you all in the next video, that is part 3 of PPE on Ind AS 16. So till then, stay in the game.